it really kind of struck me that there's some objective value being put into these forecasts. And it kind of led me on this pursuit to try to understand what that objective value is, if anything.
Warning. The political trade features probabilities and perspectives about politicians, political parties, political outcomes, and political wagering. The political trade is rated NSFP, not safe for partisans.
Well, welcome back to The Political Trade, the podcast for people with a passion for politics, probability, and profits. I'm Jeff Joseph, editorial director of Luckbox magazine, hosting the podcast where conservatives and liberals, Republicans and Democrats, partisans and wingnuts come to make money betting on politics by trading in the stock market for politics at predictit.org. Joining us on the show today is Harry Crane. Harry is an associate professor of statistics, co-director of the graduate program in statistics, and affiliated faculty in the graduate program of philosophy at Rutgers University. He's a co-founder of Researchers.one, a platform for peer review and scholarly publication initiatives for intellectual reform. Luckbox subscribers were introduced to Harry in the December issue of Luckbox magazine, which is out available now at getluckbox.com, where he wrote a piece comparing the performance of prediction markets to the performance of the polls, titled Betting Against the Political Polls. Up ahead, Harry's going to discuss his article, the research he conducted to back it. He'll answer some of his feedback from social media, and we'll end the broadcast with a close look at the upcoming Georgia Senate elections and some breaking news that we have just picked up from Robert Cahaly at the Trafalgar Group. I'm joined by Mike Ruddy, as always. Mike is an editor at Luckbox magazine, a new prediction market trader, and the producer of the Political Trade podcast. Mike, it's been a while since we've been together.
That it has, Jeff, and I thought a good way to jump into this episode is because we're going to be talking so much about polling versus the prediction markets. We should give a little bit of a recap of how the polls did, just an overview of the performance of the polls. So I did a little bit of research, and going into Election Day, the polls essentially indicated a Democratic sweep. They gave Joe Biden a 7.4 percentage point edge over Donald Trump, according to polling averages, but the margin actually looks closer to 4.5 percentage points as of today. Trump also did better in key battleground states than many expected. In Ohio, for instance, Trump had only a 0.8 point advantage in the 538 average, but he actually won Ohio with an 8-point lead. Polls on average also predicted Biden would win Florida by nearly a full percentage point, according to RCP, and Trump won Florida with a more than 3 percentage point lead. So a lot of discrepancies with what the polls said and what actually happened.
Well, that's certainly the case, and you can add Wisconsin and many others to the list, but that's really why we have Harry on. The most recent issue of Luckbox, which I said the December issue is live right now. You can pick it up at getluckbox.com. Our digital subscriptions are free. The entire issue is focused on the art and science of prediction. So not only did we engage the good people over at the Good Judgment Project and talk specifically about super forecasters from the people who created super forecasters and have curated 300 of the most accurate forecasters in the world that now have earned that super forecasting distinction. But we also used it as an opportunity to follow up on our recent election issue by asking Harry to take a look at how the polls performed relative to the prediction markets. And it's a subject of ongoing controversy and questioning by those who are active prediction market traders and those, of course, in the polling camps. And we thought we'd bring on Harry to kind of settle the story out for us, particularly now that we have some data. And this comes in on the heels of a white paper that Harry's been working on for some time that he just recently released over at Researchers.one on his web platform. And that is Models versus Markets, Forecasting the 2020 U.S. election. So that is now available at Researchers.one to see the full white paper. And more importantly, it even allows for interaction and comment by those who do read it. So we do suggest those who are really interested in this topic to take a look at the data surrounding the conversation that we're going to have today. And of course, getluckbox.com will give you access to the December issue, where Harry does have a feature story in the current issue on the art and science of prediction. So let's bring Harry on. Harry, are you out there?
Yeah, how you doing, Jeff? Thanks for having me.
Terrific. Mike and I have been looking forward to having you for some time. I know Mike and you and Mike worked closely together on the article that you did for us in the recent magazine, and it's received a lot of feedback. So let's start talking about that. What's interesting about Harry's article is right at the outset, he generated a little controversy and interest among prediction market traders. The opening being forecasters are a shifty bunch, adept at concocting preemptive excuses and post hoc narratives for why their projections are right, no matter what happens. And he illustrates a point as he goes on, looking at 538's projections in 2016, where Trump had a 28% win probability. And that was heralded essentially as a success story. Had Clinton won, her 72% forecasted win probability would have also been heralded as a success as well. And also pointing to the economists in 2020 that gave Biden a 95% chance to win. And then 538 in 2020, of course, Nate Silver published a piece before the election reminding readers that Trump could win and that a 10% chance isn't a zero chance. So they kind of covered their bases that way. But these same pollsters, of course, are vocally critical of prediction markets. Nate Silver, of course, has been critical of the prediction markets and tweets such as where he said, since almost no people have the relevant expertise to build political forecasting models, it takes tons of work. And even then, it's easy to get them wrong. Political betting markets are basically just a competition over what types of people suffer more from the Dunning-Kruger effect. What do you think about that, Harry? Yeah, and of course, the Dunning-Kruger effect. Not to cut you off your answer, but that's generally that people tend to hold overly favorable views of their own abilities. And not only does this lead to poor decisions, it also means that people are unaware while they're making poor decisions.
Right. Yeah. Well, it's a bit of a a highfalutin term way to describe the discrepancy between the polls and the prediction markets, if you'd ask me. But just to this whole discrepancy between the polls and the forecasts by outlets like 538, The Economist, New York Times, and the prediction markets is really what kind of led me to investigate this, because it really does highlight the difference between, say, prediction and forecasting, and also what it means, or what the objective is when participating or trading in an active market. It's not it doesn't just come down to predicting who's going to win. That's actually not the objective of a profitable trader. It's finding where the prices are off, finding inefficiencies in the market where, maybe it is true that, you could very well think that Biden's going to win, but bet on Trump in a number of places. You could very well think Trump's going to win a certain state, but bet on Biden. And the idea that's like back in 2016, the idea that 28% for Trump was a correct number. It very well may have been, but the question arises as to how you would go about evaluating that. Similarly, for 2020, Biden at 90%, 95%. Well, it ends up that Biden won, but was that number too high? And there's really, well, at least the way that things are set up, there's no clear cut way to address that in kind of in the abstract. But that's exactly what I believe prediction markets are supposed to be good at, or at least they're one way to try to assess this, in the sense that you could have all of these forecasts of 90% for Biden, or 28% for Trump in 2016, and you can test them out and for real. And there's kind of a real score that you would get, which is your profit and your loss in these markets.
And of course, that's what you've done, and that's what we're going to get into some of the results of that studying as well. Mike, in fact, I know you wanted to ask Harry a question right about the article right at the outset here.
Well, we received or you received quite a bit of feedback on Twitter. And so we thought one way that we could jump into this is to bring up some of the comments that you received so you can answer them. Or if some people are thinking the same things as they listen to this discussion, we can just cover these topics right from the get go. So at Shromat tweeted, "This is a great perspective. To be fair to 538, some of the predicted markets are still at 90%, even though the races have long been over. So 538 will almost certainly end up better than minus 0.8% and slightly profitable overall, low bar. But your point still holds."
Well, so a clarification on that, and maybe I believe I did mention it in the Luckbox article, but the details of this, as Jeff mentioned, there's a full blown paper behind, and a lot of the details can be clarified there. But for the analysis that I wrote for Luckbox, even though the markets hadn't settled in a lot of key states, I was making the assumption that they would settle in whatever direction was kind of the expected one. So I was already calculating it as if Georgia was settled for Biden, Pennsylvania, and so on. So the number that I provided there of a minus 0.8% ROI was in fact the most optimistic for 538, and it was actually the kind of the best that it could do. And barring any unforeseen circumstances, it is where the number would end up.
At Tupac Shat tweeted, "How are the bets sized? Fixed prices per state or some function of the gap between 538 and predicted?"
That's kind of very very much part of the methodology, and that's laid out in the article, in the longer article. The sizing in the specific Luckbox article that I chose is a Kelly criterion type of sizing, so it is a function of the difference between 538 and predicted. In the longer article, I entertain other strategies for bet sizing. One in particular based on dollar cost averaging. But the also I should say that the kind of the underlying premise of this analysis isn't predicated on any specific strategy. It's the idea that this is kind of proposing this as a general framework or a general methodology for evaluating political forecasts. You can come up with any strategy you'd like. I happen to choose these just a couple for illustration. You could choose any strategy you like, but the point being that the strategy has to be assessed. The strategy and the method for sizing bets has to be chosen ahead of time. It has to be specified in advance of the election and in advance of the outcome, so that because that's actually what traders have to do. Traders have to size their bets in real time and actually put the money up before the outcome's determined. And so, the results of an analysis like the one that I'm doing are only meaningful if the methods are laid out well in advance, and that's also what I've done in this case. For anyone wondering, the analysis that I was going to perform was published before the election. I published the paper on October. The initial version of the article was published in October, saying these are the methods that we're going to use. This is the strategy we're going to test. And then after the election, that's when we test what the results of that analysis were.
And of course, just to clarify, dollar cost averaging is a common investment strategy where either based on time intervals or price intervals that you continue a subsequent bet. It's a money management system. It typically leads to averaging at a lower price because you buy more when the price goes down and less when the price goes higher. And then the Kelly criterion is also a scientific gambling method. That's also a formula for bet sizing that was developed at Bell Labs years ago by Kelly, and it essentially takes a wager size percentage and creates a formula by let's say you have a bet with an 80% chance to win, and doubling zero point 0.8 equals 1.6, you subtract 1, and that implies you should put 60% on that bet. So the higher the probability of a win might be, the higher the bet becomes. So it's a bet sizing formula. So that being the case, and you having used dollar cost averaging and the Kelly criterion as the two betting models that you use, I'm curious which perform better.
So overall, actually, it turns out that the dollar cost averaging happened to perform better in this particular case.
Was it a material difference?
I'd say that well, I think ultimately, yes, I'd say that it was about a 3%, 3.5% difference in the end. So I'd say that that certainly is a material difference. Is it because that's a better strategy to use, or is it a consequence of, just essentially we're dealing with one election cycle, so one of the strategies was going to come out ahead? That I don't know.
Mike, were there any other questions for Harry that came to us?
Yeah, there was one more. At Suzuki ____ 420 tweeted, "Hello, when you write using 538 forecasts to bet on each state, does that mean that you would only bet on states that are of positive expected value after fees if 538 is reporting the true probability of events? Or does it mean you're depositing $1,700 to buy Dems in New York at 98%?"
Well, I think the answer to the first part of the question is yes. I don't really understand the second part of the question, but I think they're related, which is yes, I think we've already addressed that, which is that we're betting on states where there's a positive expected value as determined by the 538 forecast, and the size of how much we choose to bet is determined by the size of the discrepancy between, well, in the case of Kelly criterion, it's determined by the size of the discrepancy between the forecast and the market price.
For the sake of the results on the second half of his question, which says, or are you depositing $1,700 to buy Dems at 98%? The $1,700 representing
Oh, I
two
see. Yeah.
times $850, which is the individual cap on any one wager. But would your model allow for purchasing, making a wager above 95%, where the commissions would immediately offset any of the profit?
Well, we looked at it under different regimes, actually. So that's part of the bigger analysis. And actually, I discussed this in the Luckbox article. It Under some of the analysis, we looked at, well, what if we just ignore the commissions and fees and we trade as if they don't exist, and we get a certain ROI in that case. And the flip side of that is, well, what if we accounted for all of these things which actually do exist? What would the 538 performance be? And just, to give a little bit of a foreshadowing of this, what we find is that maybe not so surprising, but it is still, an observation, which is that when we ignore the commissions and fees, 538 comes out to be profitable to the tune of a few percent. And when we take them into account, 538 comes out to be uh, negative to the tune of a couple percent. And so there's there's a number of ways to kind of read into that, and perhaps, and I'm sure that we'll get into that, but I think that that alone kind of maybe that observation alone is maybe part of what stirs controversy, because it almost doesn't give an exact a precise conclusion of what is who is doing better. But I think it also highlights some of the good parts about models, what they're doing right, what the markets are doing wrong, and on the flip side of that, what the models are doing wrong and what the markets are doing right.
Well, that's the split decision that you've put in front of us, and we want to dig down deeper into that. But first, we're going to take a quick break, and when we come back, we're going to discuss what got you into these markets in the first place, as well as to dive deeper into your research and try to find a clearer winner in that split decision right now between prediction markets and the polling markets. So we'll be right back. And we're back with the political trade, and our special guest today is Harry Crane. And Harry's here to resolve the question, perhaps once and for all, or maybe not, as to which performed better in 2020, markets versus polling. And it's not a clear decision thus far. So far, Harry's indicated a split decision, but we want to dig deeper into his research. So let's start with a little background. Harry, what got you interested in these markets in the first place?
Yeah, so my general interest, more my research interest more generally, is in probability theory and in its applications to real world applications, real world events, and elections are certainly uh, in that realm. But what really got me interested in election forecasting and election predictions isn't necessarily the act of trying to forecast elections, which, if you think about it, the election's going to happen and we'll find out who wins. So, but it was more in trying to actually understand the meaning of what these probabilities, these forecasts that are put forward on various sites, New York Times, 538, as we've mentioned. What do these forecasts actually mean? And I was really struggling with this, as someone who researches and thinks about probability all the time. And the reason that I was struggling about this specifically in 2016, because that was a time when uh, as I was kind of walking around campus or sitting in certain places, I would overhear conversations of people talking about the forecasts, and I remember vividly after the first debate between Trump and Clinton. I don't remember the exact numbers of the forecast at that time, but I think that whether let's say before the debate, Trump went in at say a 18-20% chance. After the debate, or a couple days after the debate, 538 forecast went up to say 30-35% for Trump. I mean, these are ballpark numbers, but it was of that kind of order or in that direction, and it was certainly in the favor of Trump. And I overheard this conversation of people saying, well, that really makes me nervous that he really has a better chance of winning now. And of course, these were Clinton supporters, I guess, who I was overhearing. But it really kind of struck me that there's some objective value being put into these forecasts, and it kind of led me on this pursuit to try to understand what that objective value is, if anything. Because at the end of the day, um, this is a one-off event. It will happen or it won't, and whether I think this is part of the problem with post-election kind of interpretation is that if Trump wins and you said 40% or you said 5%, if there's no, how do I assess whether that's whether that, what the value or what the, accuracy of that assessment was? Because as we're often reminded, a 5% probability happens 1 in 20, so it doesn't rule out the possibility. So I really was kind of led to try to understand this much better, and that's what kind of led me to the markets. Unlike the 538 forecast, or unlike the polls, which give this kind of abstract assessment of the probability, the markets have a very clear interpretation of you have a very clear interpretation of what the market price means. It's a price that two people came together to trade at that price. And so it's kind of it's a more objective number. It might not be correct in any sense, or accurate in any given sense, but at least I understand what it means. Whereas I don't necessarily understand exactly what this number on 538 or any other outlet means. And part of the reason actually is because there's a lot of confusion and ambiguity that is contributed by the actual reporting about these numbers. And so that kind of is what led me to try to bring the two together and actually see, whether I could try to make sense of the 538 forecasts in terms of the markets. And this became all the more interesting once I looked at the two side by side and realized that they disagree. They disagree very clearly on what the likely outcome is, often to the degree of 20-30 cents in a lot of cases.
And that becomes the underlying value of your research. I go back to our recent Luckbox issue, speaking with Warren Hatch over at Super Forecasters, who identifies the three primary components of any forecast, being bias, information, and noise. Those being the variables that can get you closer to accuracy or further away from accuracy. And I guess what ultimately you're doing is seeking to assess the intrinsic value of polling versus perhaps markets as an information source, or how much of it is noise. So what would you say then are the benefits of more accurate prediction markets or more accurate polling? Is that just to provide for a more accurate information source and subsequently lead to better predictions for everybody, or what else is underlying that?
Yeah, I think this is really the need for this, and the benefits of better markets and also better polls is more pronounced after the latest 2020 election. And going back to that conversation I overheard in 2016, and we've seen it in 2020, people put real stock in these forecasts and in the polls. And so it's certainly, and when the polls are wrong, there's a loss of trust in kind of the whole system, and people cry foul, but there's also just a general disenfranchisement that can happen, and we're seeing that kind of play out in real time right now. So I certainly think there's a need for sharper markets. They're certainly in the public interest for a more robust, more credible market that could really provide a sharper signal and a more reliable signal that fills the gap of what's being in a lot of cases recognized as biased media and biased pollsters. And I think that it would be nice if we could have better polls as well, but there's always that underlying, especially nowadays, there's that undertone of should we trust the polls, or who ran that poll? Is the pollster biased? Do they have ulterior motives? And I know that you had on your show earlier, and someone who's been talked about a lot in this past couple months is Cahaly of Trafalgar Group, who, think about it, in his case, depending on which side of the political spectrum you're on, if you're a Republican, he's the messiah in a lot of ways, and otherwise, people consider him to be a fool. But otherwise, really, all he's doing is he's putting out polls. He's open about his personal political preferences, but at the same time, he is pretty open also about why his polls might be different, or might be giving different results than a lot of the others, in that he's proposing a new methodology. And at the end of the day, his job is to be accurate. And so I think that in and of itself is kind of pretty interesting, because he's doing, in my assessment, he's doing a lot of what should be done, in the sense of what one would hope, but maybe a pollster or someone forecasting an outcome would do. He's proposing methodologies. He's open about his own preferences, but he ultimately backs up the claims that he's making. He offered to bet Nate Silver, I believe it was $10,000, on who would be more accurate in terms of the 2020 election. That's a bet that Silver declined, claiming it to be kind of against ethics or unethical. Um, but it's a bet that Cahaly ultimately would have won had they actually placed that bet.
Actually, the offer was that a charity would be the beneficiary of it, just so he could kind of offset any of the negative implication that Silver was referring to, not to engage in the bet. But that's a good point. I forgot about that. He would have certainly won that bet. It's interesting that you mentioned him, and we can talk about that. And in fact, I want to talk about it. Um, Out of nowhere, I had a call with Cahaly just about 45 minutes before we started recording this. And he shared some interesting news with me about the upcoming Georgia election. That as we get into the Georgia races toward the end of this broadcast, I want to share that with you, because it's pretty interesting, and he thinks it's something that will move the needle. And apparently, he teased release of this information on Twitter today or yesterday, and I got a little peek under the hood as to what that information is. So we'll stay tuned and talk about that more. But it's one thing anecdotal to look at the fact that Cahaly was clearly the outlier in terms of the overall polling results of 2020, and he was the outlier that was on the right side of the curve. Have you taken a closer look at those numbers, and as to how? I mean, certainly anecdotally, we know. I mean, look, he had a tight race in Wisconsin, where the last polling showed a 17% differential. He called Florida for Trump, which was far off the averages of both 538 and RCP. But has anyone really looked at that more carefully?
I don't. I'm sure some people may have, but I mean, I just took a quick look at it recently, and I was curious because of all of the kind of pushback that I saw prior to the election. And actually, if in some ways, it's the issue of it's kind of the discrepancy, or the difference between kind of what is the objective content of the claim, and what is kind of the window dressing or the punditry aspect of it. And I think maybe people focus too much on whether or not this person has specific biases, and he's also clearly an outlier. So there's a lot of reasons to maybe discount. But after the results are settled, we can take a look at it. And having looked at least the states that I saw that Trafalgar had polls available for, which I see 10 states. And if I look at their latest poll, if you take into account the polling error, so Trafalgar could have been 2 points wrong in the direction given to Trump, +2 when it ended up being Trump +1, that would be overestimating Trump support by 1, or he could have underestimated Trump support. If you add up all of those over and under estimates, he comes out to be about 1.7 points in Trump's favor on average. But if you were to look at 538's over and under estimates in terms of their final averages of the popular vote in each of these states, they end up 4.4 points in Biden's favor. And if you compare that to the Real Clear Politics polling average, they ended up being only 2.5 points in Biden's favor. So the Real Clear Politics is just an average of polls, and we all know that after the fact the polls were off in Biden's favor. But the average of polls was only off by 2.5% in Biden's favor. But 538 was kind of overcompensating and kind of off even farther than that, 4.5 points in Biden's favor. And if you look at just in terms of their closeness to zero, clearly Trafalgar at -1.7, or Trump 1.7 was the closest in terms of being the closest to zero, which is what it should net out to be. And also, I should add, if you just look across all of these states and the 538 error in these states, they were always, in all states that I looked at in this case, overestimating Biden's support. Whereas Trafalgar was not, they were not always overestimating Trump's support. They were sometimes overestimating Trump, sometimes underestimating Trump's support.
Well, it's a material difference. It's not good news for Nate Silver, who would have lost that $10,000 bet to a charity, but that's a discernible difference between the performance. But my guess is that it's not going to be enough to raise his C- grade over at 538. I think Trafalgar, Mike, is that right? Is Trafalgar still C- at 538?
I believe the last time we checked, he was, yeah.
Yeah. I don't see him. Maybe he should be. Maybe he's playing for pass fail then instead, because I don't think Silver is going to be upping his grade anytime soon. So to your white paper, what are the key findings? What should our takeaways be in your research on models versus markets?
Well, I think that the key findings, and this gets to that split decision that we talked about earlier, is that the models are not as strong as the model proponents claim, as Nate Silver continues to claim. I think he even put something out earlier today, which was along the lines that people who are still arguing in favor of markets because the markets maybe have some built-in structural deficiencies. That's not why the markets are mispriced. It is because of this Dunning-Kruger type of phenomenon. So that argument is still persisting, and it's persisting on the basis of things that these kind of anomalous type of things that we've seen in the past month or month and a half since the election, and the fact that up until middle of last week, Trump to win the general election was still selling for 12, 13, 14 cents. There's a lot of, there's a few of those markets that you can point to and say, this is clearly wrong, and this is clearly an argument against the markets. But if you look at how the models perform on the whole over all of the markets, then clearly the models aren't as strong as the proponents who are cherry picking these certain outliers claim. On the flip side of that, though, is that the markets aren't as strong or as credible as they really could or should be. I mean, there's reasons why this 14 cent. There's a few reasons why this 14-cent Trump price may have persisted. There's also reasons why Joe Biden was to win California. You could have bought that for 94 cents on the morning of the election.
Okay, well let's talk about those individually. Let's start with the obvious one, and we know how predicted traders, particularly those who have been on the Political Trade podcast, we know how they would account for the reason that Trump was 14 cents to win as of last week, and that's the MAGA money reference that's made frequently. And I know you have some strong feelings about that, so let's talk about that.
Sure. So on that point, I mean, do I don't know if there's if I'm sure there is this so-called MAGA money in the markets, just like I would assume that there is Biden money in the markets. Of course, the argument is that the pro-Trump money kind of far outweighs the money on the other side, and that's what skews the prices. And there's a point at which maybe there's a little bit of that going on, but there's a much easier explanation, and I believe a much more reasonable explanation to why the markets were skewed. Let's just say skewed in Trump's favor. Although, to be honest, the markets still did give Biden a higher chance to win the overall election than Trump at about 60-65%. And I said so, and I talked about this on the day of the election on another show, where the more reasonable and the Occam's razor explanation to this is that they're pricing in information that's not being considered by the polls. And the most obvious thing that wouldn't be priced into the polls or wouldn't be accounted for in the polls is the expectation of a systematic polling error, because polls only account for kind of the statistical error of deviations in one direction or the other. They don't account for the fact that they're going to be systematically biased and wrong in one direction or another.
Okay, well let me back that out just before you go on with it, just for the sake of listeners. So referring to the Occam's razor element, of course, that's a heuristic, a philosophical rule that basically suggests that for the sake of evaluating any source of an outcome, that perhaps the simplest of competing theories is preferred as opposed to more complex. So you're saying that the Occam's razor application would be not that there's dumb MAGA money, but what is the simpler theory that should be preferred?
Well, the simpler theory is that the first being, just generally speaking, that there's information the markets are considering that aren't in the polls, and then
So systemic polling error, basically.
and then yes, trying to dig a bit deeper. One thing that was discussed at length prior to the election, and Cahaly was one of the people talking about this, but others were as well, which is this expectation of a systematic polling error, which was inflating Biden's chances of winning, at least the appearance of Biden's chances of winning in the polls. And that's exactly, looking in hindsight, that's exactly what ended up happening, is that there was a systematic polling error, 48 out of 50 states.
Do you think we can comfortably assign that systematic polling error that clearly occurred, as you said, in 48 out of 50 states? Can that be assigned to the shy Trump voter effect that Trafalgar championed?
I mean, I actually I don't know if I don't think we can assign all of it to that. I think that that's yet another theory to be tested in some sense. I do think that there's some evidence that gives merit to that claim on the basis of what we just discussed, which is that Trafalgar, in the states where it was active, overall had was more accurate than the polls of polls, or the average of polls. And by the way, Trafalgar is in that average of polls, so Trafalgar is actually pulling that average of polls towards itself. And so it would have been more pronounced if you remove Trafalgar from that group. So I think
Very
that
good
there is
point.
certainly
Yep.
evidence of that. And I think that there's reason to believe that some of that error is due to what people call a shy Trump effect. Of course, to quantify that exactly isn't really possible, because just like it may be there may be a shy Trump effect, there may also be a bias in the way the polls are conducted. I mean, there's a lot of sources for potential skew of the type that we saw.
Well, the other being, as you're touching upon, is the MAGA money, which is, of course, implied to be dumb MAGA money. That it's more emotional wagering than factual or logical wagering or trading. And Mike and I have spent a lot of time discussing that, trying to account for it. We've kind of looked as far as we could look behind the curtain over Predicted and try to get some demographics of the traders based on what we know at Predicted. The five largest cities in the country represent over 27% of the trading volume at Predicted. It kind of suggests that those are predominantly, of course, blue states and blue cities. That there's a significant amount of money that is not MAGA money; it's blue money and not red money. But we've never been able to account for that notion yet. It's thrown around very, very frequently by predicted traders as being the kind of solution to everything, although it's never been attributed. It reminds me, we're speaking of razors like Occam's razor. It's kind of like Hitchens' razor. Christopher Hitchens, who was a favorite author of mine, who had a razor that basically said what can be asserted without evidence can also be dismissed without evidence, and that the burden of proof actually falls on someone making a claim. If it's MAGA money, prove it, and you can't really prove it. You can't say because of this price and then the subsequent outcome that it was MAGA money. I mean, I don't consider that's a logical proof sequence.
Well, yeah, two things on that. Well, yeah, there's that argument. I think if you would apply it in 2016, you would have concluded that the opposite, right? Because I think that the markets actually had Clinton 80 cents, 80% or so, whereas 538 actually had Clinton only 72%. So if there was
That's a
where,
really good point. That isn't brought up enough. Where was the MAGA money in that election?
yeah, and I think that I guess you could argue that without the MAGA money, that the markets would have had Clinton at 90 cents. But again, these are things that can't really be backed up. But I guess another point I would raise on this is that I think you say that a lot of the traders on predicted are making these claims, and they have they have quite a bit of knowledge, at least the professional and the semi-professional ones, the people who make money in these markets. I certainly defer to them in terms of what they know of how the markets operate, not necessarily why the markets operate the way they do. But I guess one thing that I would say, and that's kind of a key point underlying the motivation of my research and things we're talking about, which is that the traders can make these claims all they want. At the end of the day, they're actually trading in these markets, and so if they believe this theory, they're at least backing it up in some sense by risking their own money on the basis of partly on the basis of this theory. Whereas the criticisms coming from people outside the market, such as a Nate Silver, who don't kind of put risk behind these claims. You know, I do interpret those a bit differently, even though I don't give any extra credence to the theory. At least I respect those who kind of are willing to back up their theory.
Sure, and there's no question about that. I think that is deserving of more credence because they're willing to back it up. That $10,000 bet for charity, perhaps being a cherry picked example of that. But you pointed a moment ago to another example, and that's Biden 94 cents to win California. Let's speak to that a little bit.
Yeah. So the 94 cents to win California is very easy to explain, and this is a well-known distortion that happens across the board in predicted. So in a lot of markets, there's what's called a favorite long shot bias, which is just the tendency that long shots, the price that you get, the odds that you get are less than you really should, given the actual likelihood that they win. And on the flip side of that, the market gives favorites a lower chance of winning than they really should, and that's because of the tendency. I think that there's psychological reasons for that. That recreational bettors, people who want to kind of have fun with betting, they're looking for the kind of lottery effect where they want to bet a little bit and win a lot, not bet a lot and win a little. So there's that in a lot of markets, but predicted kind of takes this to a whole new level because they on top of it have these extremely distortive and this very distortive and very high fee structure where they impose, first of all, a 10% commission on all profitable trades, and on top of that there's a 5% fee to withdraw money from the site. So when you look at this and you say, well, okay, on the morning of the election, I'm sitting at my computer 94 cents to bet on Biden. I could deposit $850 from my bank account, buy up shares of Biden, and apparently, the appearance of that is that I'm going to make something like a little bit over a 6% return for about 1 or 2 days worth of waiting for that market to settle. But then when you factor in all of the fees, that 6.5 or so percent return actually calculates to a 0.4% return because of the 10% commission and the 5% withdrawal fee. So on the, kind of on the face of it, this 94-cent price looks like an irrationality in the market, that clearly Biden should be at 99 cents or higher if it was possible to win California. But it's actually a rational aspect of the market, because market participants aren't incentivized to put to put money into the market to take advantage of this opportunity, because they're actually right on the cusp. If in the process of doing that, the price goes up to 95 cents, my 0.4% advantage actually turns into a negative. So that's going to discourage new money from coming into the markets. It's a source of advantage for the professionals who might already have a lot of money on the site, and so they're just kind of churning the same money through, and they can kind of pick up those pennies without as much of a big cost. But they still do have opportunity costs in terms of whether they want to use the money for those types of markets or other ones which might have a higher payout.
Right, and to use your words, actually, that results in distorted pricing as a result of these kind of structural barriers, like the commission structure, that feeds into the narrative that markets are irrational and that models give a better signal. But in fact, it's very rational when you take into account the commission structure. But that leads to a third example, though. Um, Trump still trading at 5 to 6 cents to win after the SCOTUS rejection. How do you explain that?
Well, I mean, again, that gets I think that still could be explained possibly by this same issue, which is that for predicted, the way the predicted is kind of structured, 5-6% is in that kind of no man's land. 5-6 cents in either direction is almost always there's always a potential discrepancy or margin for error in either direction, 5 or 6 cents, which means that when something gets to say 94, 95 cents, or on the flip side, 5-6 cents, that may as well be anywhere from 90 to 99%. And so, there's this friction that prevents that from correcting in the way that it really should. Um, and so I think that certainly has some, merit for explanation there. And I guess the other thing I would say to that is that if you look at Trump as of last week, he was at 14 cents. And as soon as the Supreme Court decision, well, as the Supreme Court decision was being rolled out, it went from, say, 14 cents and now down to 5 or 6 cents almost immediately. So the logical kind of conclusion there is that that was in reaction to that information. So the market is reacting to information. They may not be pricing things perfectly or reacting perfectly at all times, but it's not like that 14 cents was just out of thin air. There was some value there that was being attributed to the potential of the Supreme Court decision. And if I could just add one more kind of point on this, is that 5 to 6 point discrepancy in either direction is really affecting the prices at the high or the low end of the scale, 95 cents and above, because this still exists for the, say, 50-cent markets, but in that case it's between 45 cents and 55 cents. And so the qualitative story is still kind of credible, right? It's really hard to kind of discern, kind of intuitively, whether 45 cents is a whole lot different than 50 or 55. But when you're in these high end, there's a huge difference, of course, between 99 cents and 90 cents.
Right. And if I were to wade into your world a little bit, a little reluctantly and with a little bit of fear and caution, let me put another theory or idea in front of you in addition to that, because I think that clearly explains, the critics would look right now at the markets and say, well, how can Trump still be 5 cents to win after SCOTUS rejected, these appeals? And there's another reasonable explanation in my mind. Obviously, it's kind of a combination of a implied illiquidity premium with a little bit of prospect theory thrown in there. So, long shot bias, that's a given. That contributes to premium pricing, unpredicted all the time. There's no question about that. But also these kind of low probability bets, they seem to be, in my opinion, the benefit of a kind of a perceived illiquidity premium effect, where the nominal return on selling a likely valueless investment like Trump prevailing at this point is so minimal, having already materially deteriorated or declined in value, that there's insufficient incentive to liquidate that losing position. It's a little bit of prospect theory, right? Loss aversion theory that came out of Kahneman and Tversky, and it's kind of like the what the fuck, I'll let it ride as opposed to cashing this thing out for nothing. So you throw in loss aversion, so this illiquidity premium notion, and prospect theory. And why hey, if I bought something at 30 cents and now it's down to 5%, and you almost lose incentive, because loss aversion theory clearly is that people don't want to take those losses, and they think, and that contributes to the long shot bias. In the long run, they'd rather see twice the return to compensate for half of a loss.
Well, that's a good point. Yeah, no, that's a good point. I think that I mean, I can say also from experience myself, I do trade in these markets, not at any kind of professional level, and I see myself doing similar things when something drops to a few cents. I guess in some ways I know that maybe I should sell it off, but on the flip side of that, no, then that's an aspect of these markets as well. Nobody in these markets has all that much exposure in any given market because of the cap on the $850
That's
cap.
another good
And
point. That's
so
right.
by the time I'm down to 2-3 cents, I'm looking to sell that for, depending how many shares I have, of course, but maybe I can sell it for $20, $30. It just doesn't, really, it's not really worth my time, or it's not that exciting, or not, and also, or that
And
interesting
acknowledging
of a
your
thing to do.
loss.
Yeah, exactly. So, I do think that's a good point, and I think that that's something where, a professional would say, well, obviously you should sell it off and salvage what you can. And I think that also I'd be more likely to do that if the $20 was worth a few hundred, or maybe, obviously a few thousand, then you are kind of salvaging something tangible there.
Well, I think that's an interesting discussion, particularly trying to account for this the structural barriers that feed into the narrative that the markets are irrational, and the distorted pricing that results from these kind of structural barriers. So, thank you for that. I think that gives a lot more insight in this market versus models comparison. But what we'd like to do is take a quick break and then come back and ask you, using that same lens of the research that you've just concluded, what can we learn about how the Georgia markets are currently priced, the general and special election for the Senate runoff in Georgia? Because there's some inconsistencies there, and some real distortion between the markets and the models right now. So let's take a quick break. We'll be right back, and let's talk about Georgia.
Want a little more luck in your life? Get Luckbox, the control freak's guide to life, money, and probability. Named Best New Magazine of 2019 and 2020. Luckbox is the must-read magazine of active investors, big thinkers, side hustlers, entrepreneurs, gamblers, data geeks, and risk takers. You can buy Luckbox on newsstands, but with this special offer, receive a 10-issue digital subscription absolutely free. Visit getluckbox.com/TPT to receive the award-winning Luckbox in your inbox. Don't rely on luck, get Luckbox. Learn more at getluckbox.com/TPT.
And we're back with the political trade. Our special guest today is Harry Crane from Rutgers University, and we're trying to make a final decision, focusing on the split decision between how the prediction markets performed in 2020 relative to the polling markets. Of course, that's still a work in progress, because we got a couple of elections that are still coming up that are not only going to be material in determining the balance of Senate and legislative control going forward for the country, but also to fill in the blanks on missing data with respect to this election and researching the differences between polling and prediction markets. But during the break, just a moment ago, our discussion continued, and I pondered to Harry whether or not an analysis of the prediction markets that excluded the tails. So, if considering the binary option pricing of 0 cents to a dollar, right? 0 to 100 cents. What happens considering the distortion provided by the systemic commission structure that's inherent in Predictit? What happens if you lopped off the 0 to 5 cent range and the 95 to a dollar range, for the simple reason that we noted there is an aversion to sell below 5 cents and illiquidity at that point, and there's an aversion to buy over 95% because of the commissions offsetting any possible gain. So, would we get a more accurate assessment of comparing prediction markets to polling if we just looked at the 5 to 95 range? I put that question to Harry, and Harry, I'll put it to you again so that way our listeners can listen.
Right. Yeah. So I, I think that this is a good question, and so this type of this exact type of analysis you suggested, where we cut off the tails and we only look at markets kind of in between. That's something that I did in my analysis of 2018, the midterm race. I was reluctant, and I'm not doing that exact analysis this time around because there's obvious kind of source for criticism in that, well, it's a bit arbitrary. Why are you cutting those off? That's the exact regime under which 538 has a huge advantage, and you happen to be eliminating that. So that actually, I think there's a better way to account for it, and that's where when we after we account for the fees and the commissions in the markets, you can think of it as kind of being a natural way to account for these distortions. Because on the one hand, the existence of the fees creates the distortion, which on its face presents an opportunity for a smart investor to make money. But on the other hand, that fee makes it harder to actually profit because you have to pay the fee. And so, I mean, it's worth kind of noting on the topic of the split decision is that the what drives that decision is that the primary advantage of the 538 models over the markets exists in that very high probability region. But when we take into account the fees, the magnitude of that advantage disappears, and then we're left with kind of a more realistic assessment of how the models would have actually done if they were forced to kind of actually trade in these markets and deal with all of the realities and practicalities that comes with that. And so, in a sense, as we discussed earlier, that those extra commissions and fees diminish a 95-cent buy on Biden in California to actually an unprofitable trade and makes 94 cents slightly profitable. And so it has the effect of essentially cutting off the tails like you suggested. And I think it does it in a more natural and a more realistic way.
And you had, from that conversation, you had something else that you wanted to share before we jump into Georgia.
Well, I think that I think that on that note, I would say that you could render this a split decision, but I would actually be much more inclined to. I don't think that it's. I think that it's a split decision because we've highlighted kind of positives and negatives of both sides, but I think that the ultimate kind of conclusion that I draw is that the models do not beat the markets, and you can see that after we take into account the fee structure. But at the same time, the markets do not give the sharpest signal, giving a 94-cent chance to Biden in California, which is going to be interpreted naively. But naturally going to be interpreted as a 94% chance, is not the type of thing that is going to give credibility to these markets. And so those are my two main takeaways. And I think that ultimately I'll also just comment that one of the criticisms that I can foresee and that I've already seen of the article I wrote for you and the subsequent analysis is people insisting that they made money in the markets this time around, and kind of insisting that that's evidence that the markets are as dumb as claimed. And I guess to that point, I would say that first of all, anecdotally, I made money in the markets this time as well. Not a very large amount because I'm not a high volume trader, but the point stands that to be a kind of a profitable or a smart trader, it involves synthesizing all of the information that's at our disposal, which includes the 538 and the other forecasts that are out there. There is information in those forecasts, and so smart traders are wise to use it, and the good traders know how to use it. But that doesn't mean just blindly following what those numbers say. And I guess what I would say to that is, finally, is that, and I think that traders and people who are still kind of proponents of the polls versus the markets, and traders who consistently beat the markets maybe don't quite appreciate or always realize how much additional expertise they're bringing into the activity of kind of massaging these polling results to get at the right number and to make decisions, better decisions than these models would make on their own.
Well, I think that's an interesting argument, but I agree with you. That's easy to discount. I mean, look at the capital markets, right? The stock market. They're widely accepted to be pretty efficient markets with all information factored into pricing. At least that's the consensus, and that's the one that I believe in as well. Yet there's still winners and losers. There has to be. The markets are essentially a zero-sum game. So the mere fact that someone actually beats it is not any validation that the market is dumb. It's just essential to market structure as a zero-sum game. So I think it's easy to discount that argument. So if I'm judging this overall, and I have a bias, I don't mind admitting that the prediction markets certainly this time around have proven much more valuable than the polling markets. And since this is by decision, I'm going to give the decision to prediction markets over the polling markets. I think we have a winner here by decision. But as we said, there is some outstanding data here, and it's not only important to the country and its political direction, but it's going to fill in a lot of blanks too, because there is such a disconnect between the prediction markets and the polling markets in the two upcoming Georgia elections, the Senate election and the runoff, the special election. And Mike, can you kind of break that down for us, what things look like right now?
Sure. So let's start by taking a look at the which party wins the regularly scheduled 2020 U.S. Senate election in Georgia market. So in that market, 1.3 million shares have been traded thus far. The Republican David Perdue is trading around 66 cents, and the Democrat John Ossoff is at 37 cents. Now, a few notes about the polls. 538 as of yesterday gives Democratic challenger John Ossoff a 1 point lead over Republican incumbent David Perdue. That's at 48.5% to 47.5%. The RCP average has Perdue ahead by 0.5 points at 49% to Ossoff's 48.5%. And including leans, Trafalgar Group gives Democratic challenger John Ossoff 49.1% to Perdue's 48.8%, so a 0.3 point edge.
But what happens when we look at Loeffler versus Warnock?
In that market, which party will win the U.S. Senate special election in Georgia in 2020, where roughly 1.1 million shares have traded? Republican Kelly Loeffler's at 61 cents, and the Democrat Raphael Warnock's at 43 cents. Looking at the polls, 538 as of yesterday gives Democratic challenger Raphael Warnock a 1.6 point edge over Kelly Loeffler at 48.5% to 46.9%. The RCP average has Warnock ahead by 1 point at 49% to Loeffler's 48%. And also including leans, Trafalgar Group gives Loeffler a 50.4% to Warnock's 47.3%. So a 3.1 point edge with an additional 2.3% of voters still undecided.
Harry, explain this to us. What do you think is going on here?
Well, one thing that's interesting about that I just realized is that everybody, for the most part, the polls, the markets, and 538 seem to line up in giving Perdue a better chance than Loeffler, regardless of whether you say that whether Purdue's more likely to win than Ossoff, but giving Perdue a better chance than Loeffler, except what you just said about Trafalgar, which is giving Loeffler 3.1. But Trafalgar only gave a Perdue about a 0.3 percentage point advantage. So that I don't know. That's just something that I just observed. I don't have a deep analysis of it.
So his outlier status is definitely going to continue here. So let's take a look at that again. As you said, 538 has Warnock up by 1.6 points, and RCP has a 1 point advantage of Warnock over Loeffler, but Trafalgar gives a 3 point advantage to Loeffler over Warnock. So there's a big swing there. And And I think if anything ultimately is going to define whether or not Cahaly and Trafalgar are onto something, it will probably be this particular race, because unless those numbers tighten up a little bit, he's really standing outside the mean on this one in terms of his predictions. And interestingly enough, and kind of breaking news, Mike, I really didn't get a chance to share this with you because we were just about to bring Harry on, but I had a call with Robert Cahaly from Trafalgar Group just about an hour before we started this broadcast, and and I had asked him specifically about Georgia, if there was anything new to share there, and he kind of gave us some breaking news. Now he's been teasing a little bit. There was a tweet. In fact, Mike, do you have it? Could you pull up Trafalgar's most recent tweet about Georgia?
This is Cahaly's tweet from about 16 hours ago. I think this is what you're talking about. Cahaly tweeted, "Remember when Trafalgar Group polling showed Big Ten not playing football was unpopular with voters? Then the agenda-driven pollsters/pundits mocked and dismissed this idea until the moment Trump and Biden addressed it. Our recent polls in Georgia about changing Braves are just as clear."
So, so there's a voice here that is discernible. It's kind of like Rodney Dangerfield. I don't get any respect. Hey, remember when I said this? And I think he's still trying to earn his stripes and prove credibility. I think what he needs to see is his C- rating goes up. So he sounds a little defensive there, but I think in terms of how well he performed in the last election, I guess I understand it a little bit. But what he's alluding to, and I had not seen the tweet, but he asked me to he spoke more clearly to what he's referring to is that, as we all know, recently the Cleveland Indians made the decision to drop that name, the Indians, from as the name of the team. They dropped a mascot, which was patently offensive a couple of years earlier, but they recently decided to drop the Indians in the same vein that the Redskins dropped the Redskin name and became the Washington football team, and Cleveland is pending a new name. Well, what Cahaly is getting at here, somewhat cryptically, is that in the state of Georgia, sports matter, and they matter in a big way. And apparently, he has been polling for several years now and has accumulated polling data on this, but more aggressively since the Washington Redskins dropped that name and became the Washington Football League. He's been polling Georgians on their position, pro or con, against the potential of changing the Atlanta name, the Atlanta Braves, which has always been a subject of discussion of whether or not it was time to reconsider ditching that name, the Atlanta Braves. And there's some sensitivity within the state, and apparently the numbers are pronounced. And what Cahaly told me just an hour ago is that today, and I say today, he'll be releasing later on today the actual results of that poll, and that he believes it's going to be market moving and needle moving, and he thinks it's going to have an impact on the betting markets as well. And I guess what he's getting at from probing him is that Loeffler and Purdue are both going to make statements, or perhaps already have made statements, that are very much in favor of retaining the Atlanta Braves name, and that Ossoff and Warnock are going to be forced to take an opposite position, particularly in light of their constituency, to be palatable and acceptable to them, and that is a divisive issue within the state, and that the polling will indicate that, and that this question will take the Democrat senatorial candidates in Georgia off message materially and will move the needle. That's interesting. We're going to have to look for that. We got a little bit of tease. He didn't tell me everything there, but apparently Trafalgar has been tracking this issue. He also told me, because I asked him specifically how he was tracking these two races, and the numbers are what you just stated them to be, Mike. But when I asked him for him to account for the social desirability bias, that's what he referred to as the underlying premise behind the shy Trump voter, to what extent that social desirability bias exists within these two Senate races. And he said, perhaps not surprisingly, that it is very evident and quantifiable from his own data in the Loeffler race, but not in the Purdue race. So the result of that, he said, Loeffler is losing in all the live caller polls. And as you know from the extensive interview that we did with him when he joined us on the podcast, he thinks live caller polls contribute to polling error because of the social desirability bias. And that he said that's why all the polls are understating Loeffler's vote. And that explains this differential we're seeing. So Harry, I thought, that's kind of breaking to hear it directly from his source. We just had that conversation an hour ago. Any thoughts about that?
Well, that's interesting. That answers the question I raised, which was just identifying that Trafalgar's, more skewed, more bullish on Loeffler than on Purdue, which is the opposite to everyone else. And I guess I don't know. This is speculation, but I'm curious the extent to which this poll on the Atlanta Braves would whether Cahaly himself, whether he would have any insight into whether he can interpret that in terms of social desirability biases, whether or not in Georgia people are more open to kind of give their opinion about the name of the team rather than give their and they feel more comfortable doing so rather than saying who they wish to vote for. That's just kind of a thought that I was having as you were explaining that.
Yeah, his explanation is essentially that it'll take the Democrats off message, and that the siding of drop the Braves or not will become a political issue with the positions being identified by the two candidate choices.
And
Yeah,
yeah, I guess the last thing, just I think this kind of gives a kind of pulls things together here in talking about this race because there was a lot that you just threw out there from Cahaly, and I think that it's interesting because some of it is based on hard numbers and a lot of it, some of it is based on kind of his assessment of what's likely to happen politically and where the message is likely to go. And that's kind of this gray area, this fine line between the quantitative, the hard numbers, and kind of the analysis and the punditry kind of stirring around those numbers. But the nice thing about it is that the numbers are there, and right now in for this race, we see pretty clearly the polls. 538 is giving as Mike mentioned, 1% advantage to Ossoff, 1.6 to Warnock, which they don't. Interestingly enough, they're actually not giving forecasts. They're not giving percentages for these. At least I didn't see any on their site. But I would ballpark that to kind of put Ossoff at about a 65%. That's kind of where I would guess that number translates to, and Warnock about 70%. Whereas if you look at the prediction markets again, it's almost the exact opposite, right? Giving 37 cents to Ossoff, 43 cents to Warnock. So again, a clear distinction between the polls and the markets, and this will be an opportunity to see, where things end up.
and this will be an opportunity to ask you to come back and share those conclusions with us.
Sounds great.
Well, Harry, we've really appreciated having you on to try to lend some final accounting to this question, but we'll keep it open through Georgia, and because there's such a dissonance between polling and the markets right now. So let's see how that outcome presents itself and to how it contributes further to making this ultimate decision here about markets versus polling. And we'll have you back and we'll flush it out. So if you want to follow Harry, as you should, he's active on Twitter. He's at Harry D. Crane, Crane, on Twitter. Of course, his website is harrycrane.com. His research is posted at researchers.one, and that is where his recent white paper on models versus markets forecasting the 2020 U.S. election, which was released only on December 12th, so it's very, very new research. It is at researchers.one, and you can actually comment on the research there as well and continue the dialogue. So Harry, thanks much. We do look to have you back after January's election and tell us how things settle out. And thanks so much for joining us. And again, some other announcements just to remind readers, if you want to hear more and read more about Harry's analysis, He has a feature article in the current issue of Luckbox magazine. That's the December issue, which is the art and science of prediction. There's easily 15,000 words devoted to this subject of prediction and forecasting and dissecting what is art and what is science. And we even interview 3 different super forecasters. These are people who have been identified in the world as having 30% more predictive accuracy on their own forecasts than government intelligence agencies, and among the top 1% of forecasters globally. So it's a deep dive into the art and science of prediction. We invite you to go to getluckbox.com and pick it up for free. But some of you like print, and it's worth noting that our print magazine, the print editions of Luckbox magazine, of which regularly sell for $7.99 on newsstands, but who's going to newsstands nowadays? And the subscription is 10 issues, which is a 1-year subscription for $39. We've just added a kind of holiday special to that for the month of December. We're adding in a free Luckbox t-shirt for a subscription, a $39 10-issue 1-year subscription, and you'll also have a Luckbox t-shirt. So, it's funny, since we launched Luckbox magazine, and, we're the most awarded new publication of 2019 and 2020. With all the great editorial we're producing, the question we seem to get most frequently is, how can I get a Luckbox t-shirt? So we finally had to address that, and you can get it for free by simply subscribing to the print magazine. So we invite you to take a look at that. That said, we also, Mike, we want to be able to share some interesting news about the Political Trade podcast that we're hoping to have to share with our listeners today, but we're not quite there. But we have some fun news coming up, so tune in next time. Subscribe to us wherever you listen to podcasts, and you can also check out thepoliticaltrade.com, and that's to sign up for our newsletter, to find us on social media, or send us a message. It's all there at thepoliticaltrade.com. And if you subscribe, we hope by next episode, we're going to have some really interesting news about the podcast going forward that we know we expect you'll appreciate. So thanks again for joining us today. This is Jeff Joseph.
And I'm Mike Reddy.
And remember to believe in math, master your trade, and join us next time on The Political Trade.